Hello to Blue Dragon Actuarial. So today is the last and final part of Curious Case of Discount Rate, part 3. So obviously that would mean if you are watching this video, then you need to watch this, the Curious Case of Discount Rate part 1 and the Curious Case of Discount Rate part 2. Otherwise, you'll have difficulty in understanding what is going on, right? And this video would be slightly more calculation intensive and may take some more time. So you need to be very attentive watching this video and probably need to sit with a pen and paper to understand what is going on. So today we are going to integrate two concepts, that is embedded value and discount rate, and how the interplay between embedded value and discount rate is affecting the is affecting the embedded value calculation basically, right? So if you are not aware, although that is not the the target for this video, embedded value is actually can be decomposed into two components. One is called net worth and other is called PVIF, or present value of future profit. Okay. Or or present value of in force. It can also be called present value of future profit, whatever you want to call it, right? So what is your net worth? Net worth is you have total asset of 200, say, okay, and you have best estimate liability, which is written here as well, of 100, say, and you are calculating margin as 100 into 50%. 50% of your bill will be margin. So this is just an assumption that I've taken. There are n number of ways you can calculate the margin, right? So I mean, that's why I'm just taking a simple example, and that's why this is simple assumption. So this would be your reserve. This is your prudent reserve. So 100 plus 50. So the best estimate liability is 100, margin is 50, and this is your prudent reserve. In this case, you have assumed that the investment income is 1.04 and the discount rate is 1.04. So obviously this assumption will hold in any scenario. If you are in IFRS 4 or Solvency 1 regime, where the reserve is calculated in a prudent manner. So we know that the interest rate has to be so this can be at least equal to the discount rate or more than discount rate, right? If you are struggling here, then you have not watched my curious case of discount rate part 1, right? So there I have given the explanation why the interest rate would be more than the discount rate or equal to discount rate. It cannot be less than discount rate because it's a prudent regime. If you are in market consistent environment, right, which is the subject matter of my discount rate calculation, or the prudent the curious case of discount rate part 2, there I have mentioned that the investment, so when the amount with which the the reserve would increase would be risk free rate. So in this case, we have assumed that the risk free rate is 4%. So in that case, the interest rate and discount rate cannot be different, right? So so in this case, the what is net worth? Net worth is my asset is total of 100 and my reserve is 150. So net worth at a particular time, this is determined at embedded value is determined at a particular point of time, like balance sheet, right? Embedded value would be determined at a particular point of time. So at that point of time, I have because this is, you can see that this is a balance sheet item, right? Asset is a balance sheet item. So at a particular time, your value of the asset is 200. At a different time, the value might be different, right? Because the value is floating, the value is changing, the value of equity will change in 1 second, right? So that's how it is. The value of bond will change in 1 minute. So that's how it is. So 200 minus all of this, right? 200 minus 150 would be 50. So that is your net worth. Now assume this 50 margin, right? If your expectation is as per best estimate. So when we are calculating embedded value, we are only calculating on an assume basis. There is nothing actual that you are kind of considering here. So that is because you are on today's date, you are calculating what could be the modality, what could be the expense, what could be the lapse, etc., etc. And depending on that, you are projecting it and you are discounting it. So how you are going to project it, that is very important to understand. So you need to understand the calculation first, how we are doing that. So this 150, so this is an end of the period figure, right? And this is the end of the period figure for this year, which I'm denoting by T0. So at the end of T0, the reserve is 150, right? So this 150 reserve, when it will come at the end of T1, it would gain the interest rate, right? It will gain an interest. So that interest would be 150 into 1.04, right? So that is what is written here. But the margin would be, this figure would also consist of the margin, but we know that how the margin is calculated. the margin is calculated as 50% of the bill. So what would be the bill in this case? Because we are calculating the bill, right? We are not calculating the reserves. So for that, this margin has to be deducted. Now this margin would also gain the interest, right? That's why what we have done is this if so this total figure into 1.04 minus this margin figure into 1.04, that would give you the bill, starting bill, or the that will give you the bill at the end of the year, right? So if the bill is 104, obviously what would be the margin? Margin would be 104 into 50%, that is 52. Now, what we have assumed here is your experience, actual experience is exactly equal to the best estimate experience. So what is your best estimate experience? Was 104. So if your that means that while in that year, the number of deaths that have happened, for that you have to pay a claim of 104. You have kept a reserve of 104, and you are exactly paying that amount as the claim, right? So there would be no profit, no loss, right? In that sense, because you are paying the reserve. But actually there would be profit or loss because the margin would be released. You have 50 rupees margin, right? But this 50 rupees margin is not used here. For example, in this case, you have kept 52 rupees as margin, but that 52 of rupees margin is not used at all. The best estimate liability is or the reserve that you kept for the best estimate portion, that has been factored in. So 104 that you have kept, that 104 is getting deducted, but this margin is staying the same, right? And that's why your reserve would be coming out to be 52. So in the next year, by same same calculation, it would be 52 minus 52 into 1.04, which would be 52, and then that would mean the reserve at the end of the year would be 0, which is expected, right? So in this case, we have assumed that the term of the policy is for, or the term of this portfolio is for 2 years. So at the end of the year, the book has ended, right? So if the book has ended, there is no enforced policy. If there is no enforced policy, then that would mean 100, the reserve would be 0, right? Because there is no enforced policy. So if you have struggled anywhere, then you have not watched this video of mine, which is the interview series video that I've kind of created. What happens when a person dies, right? What happens actually when a person dies? So if you are struggling anywhere in what I have explained till now, then that would mean you have not watched this 3 video. So you have to watch all these 3 videos. First is the curious case of discount rate part 1. You have to watch it thoroughly and understand it. Then curious case of discount rate part 2, and this interview series episode 2, which is what happens when a person dies, right? So now, if we go back, so in this case, you see that the because we are considering the market consistent scenario, right? Market consistent scenario, then the discount rate and the interest rate would have to be same because it is risk-free rate. We are assuming that the liability is increasing by the the risk-free rate, and that's why it is also getting discounted by the risk-free rate, right? As obvious as that. So what is happening here? The margin that is kept at the start or at T0, that margin is getting that same margin is coming here as the present value of future profit, because your experience is same as the best estimate. So whatever best estimate liability you are keeping, that best estimate liability is taking care of the claims. Then whatever extra portion that you have kept as margin is getting released, which is very intuitive and very obvious. So your embedded value would be, this is the net worth plus present value future profit, which is 100. So basically that means in this case, because of the market consistent valuation, because of the discount rate is kind of same, right? Because of the discount rate is same as the interest rate. So your embedded value is 50 plus 50, which is 100, right? Now, if you are in a different scenario, say you are in solvency 1, right? In solvency 1, it can be prudent, right? So this 1.04 can change, right? And it can be more, right? So in this case, it cannot be less, but it can be more, right? Because of the prudent concept. So suppose this is 1.07, how would it change, right? So in this case, you will see that because it is higher, the PVIF increases. Is that obvious? Is that intuitive? Yes. Why that is intuitive? Because your bell is increasing at a higher rate, right? Your bell is increasing at a higher rate. That means you are keeping more margin because your margin is 50% of that higher bell, right? And it is getting discounted at a lower rate. So it means you are keeping a money or keeping some reserve aside that is getting increased at a higher rate, but when you are discounting it at a lower rate. So that would mean there is two impact. First, the bail is increasing, right? Because the bill is increasing, the margin is increasing, right? And that because our our actual experience is same as the expected experience or the best estimate experience. So this 107 that is coming here, same amount is coming here, that is getting nullified, right? And but the margin that is that we are keeping, that margin is increasing because our bill is increasing, and also we are discounting at a, so that is one factor that is contributing to higher margin or higher release of PVIF, right? And the discounting factor is same, right? 1.04, and that's why this is this the PVIF component increases, right? Now in market consistent valuation, it can also happen that the investment income, suppose by some odd logic, you are saying that the investment return is say it is lower than the discount rate, although you are expecting the discount rate to be risk free rate. Because of some manipulation, maybe there is some adjustment that has to be applied because of some change, right? Something has happened, or the discount rate is slightly higher, maybe because of some volatility adjustment, or the market matching adjustment, etc., etc. Suppose your 1.04 changes to, so in this case, let me change this back to 4, right? And here I'm changing this back to 5, say, or 6, because there is a say a matching adjustment, because this is an annuity portfolio, and because of the matching adjustment, what I'm doing is I am using a higher discount rate, right? So the apart from risk rate, we are adding the matching adjustment. How would it happen now? So in this case, the PVIF decrease, right, and the embedded value decrease. Why the PVIF is decreasing? Is that is intuitive? Yes, of course, because our reserve, in this case, what is happening? The reserve is increasing at a lower rate, right? Because your interest is 1.04, but you are discounting it, right? So your reserve earlier was supposed to be, when it was, say, when it was 7%. So when it was 7%, it was, right. When it was 7%, it is 107, right? But when I'm changing it to 4, it is obviously expected to be 104, right? So because this reduces, the margin reduces, right? And also the second factor here is we are discounting it at a higher rate, which is 1.06. Instead of discounting it at 1.04, we are discounting it at 1.06. So that would mean that the PVIF would decrease, and hence the embedded value would decrease. So how is the interplay happening? If the interest rate is equal to the discount rate, right? If it is 1.04 and it is also 1.04, then the margin that we are expected to release at T1, at the point of time when we are kind of calculating the embedded values, the same margin would be released here, right? And that's how the net worth is not changing, because net worth is at a point of time, right? Net worth will never change. Net worth will not depend on the interaction between interest rate and discount rate. So the embedded value would be 100. But if then the discount rate increases, right? If the discount rate increases, what would happen? The PVI will decrease, right? So the embedded value will decrease. This is not changing, right? But however, if the discount rate reduces, right, in this case, and the interest rate is higher, in that case, the PV embedded value would increase. So I think by this calculation, this methodology, I think both the things will be clear. How embedded value is calculated, right? What is the embedded value? How the release of margin is kind of being captured here in PVI, right? And how the interplay between interest and discount rate is affecting. So this is a question that was asked by my friend Gajanan, who has kind of messaged this to me in LinkedIn, and I kind of took 3 videos to kind of come to that final answer, because had I answered it in the first video, probably he would be able to understand that because he has some experience, but it would be very difficult for other people to understand that. Now, the second portion that is remaining is this how it works in actual environment? In actual environment, it will be slightly different, because I have kind of simplified the definition of embedded value. Now, embedded value is also, there are types of embedded value. There is TEV, which is technical embedded value. Then there was book. Then they have moved into market consistent embedded value, in which there is time value of option and guarantees. There is cost of capital associated with risk margin. So there are multiple components, right? So I have kind of, but these two are the main components. Net worth and PVF is present in all definition of embedded value. These two are the main component, but I can also complicate it by putting a CR, NHR cost of residual non-hedgeable risk, or cost of capital, etc., etc. But I have not done that because I wanted to keep it simple. So if you consider pure market consistent environment, which is so other which is just like solvency 2, other than this interplay there would be some other interplay which I like to kind of quote from the book, which is SA2 book. So what would happen is profit that are expected beyond the solvency to contract boundary, that would also be released. So what is contract boundary? That's a separate discussion. Just to explain in a very simplified manner. So suppose you have a term policy and you have an option to kind of alter the policy to an endowment policy, maybe 10 years, right? And that when that happens, then underwriting will happen and the premium would change based on that, right? So your contract boundary in that case, because you have not, while pricing, while calculating the premium, you have not considered the policy would be changed to whole life policy, right? So that's why the contract, if the term of the term contract would be 10 years, then the contract bond in this case would be 10 years. However, actually, if you have altered it, and at that point of time, you can, maybe the whole life term is 20 years. So the duration of the contract for this kind of contract would might be 20 years, right? Because there is a term of 10 years for the term product, it can be altered to whole life after underwriting, and then would be another, then it would be for another 10 years, right? So in this case, the term would be 10 years, but the contract boundary would be 10 years. But contract boundary is a very complex subject, and it is a matter of different, video. But if there are profits that are expected beyond the solvency to contract boundaries, that would be released in the PVIF component. So the same example, if you have a term contract and you are altering it to whole life, so that would not be considered captured in PVIF, right? When you are kind of calculating that. But if you are changing it at that point of time, this PVI component also include any profit or loss coming from that conversion, right? So any difference between the best estimate return assumed in the embedded value projection basis and the discount rate. So this portion, this is the second portion which we have clearly seen here. Any difference? So if the interest rate is higher, then the PVI would be higher. If the interest rate is lower than the discount rate, then the embedded value would be less, right? So that we have exactly and clearly seen, right? Next would be for with profit policies to the extent that are not allowed in the one fund. So I think this is once again a separate concept which I would not like to kind of consider it here to that would may over complicate that. But for with profit policies, just to give a slight example, for with profit policies, whatever be the bonus that would be given to the shareholder, or whatever the dividends that is allowed to the shareholder, that should be considered as the embedded value. The PVI would be the discounted value of that. And if something other than that is kind of considered, for example, there is a in special year, there is a special bonus that has been kind of announced, right? It was not supposed to be announced, but it was announced for that year. If that is not captured, then that should also be captured here in the embedded value, because initially that special bonus might not be part of an assumption, right? It is only a surprising thing that has happened. Maybe some year they have done tremendously well, and that would be captured, right? And once again, the third portion is the release of risk margin. So this margin that I have considered here, it can also be called risk margin in solvency to in IFRS 17, it's called risk adjustment. So in this case, I think it is obvious that this 50 is coming here, right? If we change this to 4, right? So this 50 is coming here, right? This is this 50 that is coming here, right? So I think right now, so those are the points, right? So I have shown you the main point is obviously the interplay between interest and discount rate. That was the question that Gajanan actually asked. And then after that, I think remaining points are just an additional kind of thing to just to give that completeness to this, just for the completeness sake, right? So yeah, so don't consider this. I was trying to overcomplicate this. So yeah, don't consider this. This is how it works. So I hope this is clear. And I request everyone to kind of, I'll not provide this Excel file, but if you want to do this calculation, if you want not to be a paper actually, do this calculation, try to replicate my calculation Excel, because you have this sheet, right? You know you can do this calculation, you can match, right? And obviously this figure would tell you if you are doing it correctly or not, because the bell has to be zero at the end of the time period, because there is no enforced policy, so the reserve would be released. So If you are doing it correctly, then the bell should be 0 here, right? So replicate this in your in your own Excel, and try to see if you can come at the same answer, or if there is any discrepancy, if there is something that you have not understood, please ask in the YouTube comment section. But before asking, I'll urge you to see those three videos. uh, if and until unless you have not seen those three videos, then you would not probably you would have difficulty in understanding this. But I think overall, the basic sense of this is how the interplay between interest and discount rate affect the embedded value, and that is extremely clear from the example that I considered. So please like the video if you have understood something from this video, and if your concept has got clearer, because I believe that this video would help you in getting clear concept. I remember there was a seminar that I attended from Institute of Actuaries of India, and I mean, in all that entire 8 hour seminar, people just went on saying blah blah things, but they have not produced this Excel. Had they been producing this sort of Excel, it's so easy and simplified to understand that every concept in actuary I try to understand in this manner. Like what would happen if I put that in Excel and try to do my calculation and try to vary it so that I can see the numbers change in front of me. Otherwise, it would be very difficult to develop that conceptual clarity. So if you are some person who is doing that in addition to memorizing and regurgitating your concepts, then only you can become a good actuary or better actuary or best actuary. So thanks for watching. Please like the video if you have understood something, if your concepts are clear, and please hit the bell icon. Please subscribe to my channel. Thanks for watching, and see you in future videos.